I'm Wendy.
We'll discuss about a random walk down Wall Street book. Enjoy!
Halo Pak Ben, how are you?
Hey, Pak Hendy ya?
Yes.
Long time no see ya.
Iya Pak. Oke, thank you Pak.
So,
Aduh.
how's things?
The business is good, but for my personal investment is very bad.
Wow, why so?
Because you know that the situation is not good for investment. Like talking about the crypto, talking about the investment and support for us.
Oh yeah, I think I experienced a similar case, but yeah, a couple of months ago.
Yes.
Yeah, the time deposit is not so good, the rate, right? The property is not also the leasing income. It's not so good also, but a friend of mine just introduced me how to make money in stock market.
Nice.
And very simple.
Okay.
You don't have to learn about the fundamentals. You don't have to hear the news.
Oh, okay.
You just focus on the chart.
Oh.
Let me show you, Pak.
Okay.
I just invest in
Interesting,
this
Pak.
stock. You see?
Yes.
I invest at this level. Yeah.
Yes.
Then now it's at this level. So
Yes.
how many percent?
I think 50%, Pak.
Wow, that's good, right?
Yes, good.
So maybe we can arrange another time. I will show you in more detail how we can make money in
I'm
stock market.
very want to learn about
Okay.
this, Pak. Okay, Pak. Sip.
Good.
Okay.
Many months later.
Yeah, this is the stock that we just invest, Pak.
This is candle.
Yeah, we just see.
Okay.
See?
Yes. I think
It's
easy.
easy, right?
Yes.
Easy. Going up
Interesting.
now. 10%. Oops, going normal. Going down is normal.
Okay.
See, it's going up again, Pak. See, it's
But
good.
It's
Normal, Pak. Normal. It's normal. It will go up. See?
Yes.
This is good. See? Right?
But still
Good.
going up, Pak. Oh,
Good.
good, Pak.
Good.
It's the money, Pak. 50% lagi nih, Pak.
Nice.
Oh,
it's
Pak,
going
kita.
down. Normal. Wow. I think we should sell. Okay, let's sell.
Yes. And
Wow, it's going up again. Let's buy. Wow, going down again. Let's sell. It's going up again.
Yes.
We buy.
Yes, Pak.
See? Now it's going up again. Wow. Safe now, Pak. Safe. Oops, going down. Wow, we have to sell.
Okay, Pak.
Wow. There goes our money, Pak. We lost.
It's the big one, I think, Pak.
Yeah, we did.
Previously, you say this is good for investment, but this is.
Yeah, I think we have to learn more about the chart, Pak.
A few moments later.
Pak Hendy! What happened? Why you look so sad?
We
Our money
just
is
lost our money, Pak Hendy.
How
Yes, the stock
come?
market.
Robbery.
No, we just lost in the stock market. Yeah, you can say it's robbery by the stock market.
Oh my God, how much
Yeah.
you lost?
Wow, a lot lah, a lot.
Very
Yeah.
huge, Pak Alman.
Yeah, how come you very expert in stock kan, Pak Benny? How come you lost?
I just follow a friend of mine and he taught me
Fraud
about
investment
technical
or-
analysis.
Ah.
Yeah, it just rely on technical analysis.
Yeah, I think Pak Benny, based on what I learned from workshop from Professor Roy Sambel,
Yes.
you cannot rely on chart only, Pak.
Oh.
Because it's not reliable.
Okay.
Only less than 50% is reliable on the chart. I
Just
think.
how? Oh.
Yeah, we need to see the overall picture of the company itself. So
Okay.
combining fundamental and technical analysis.
What is it?
Yeah. I think we might be need to learn together. Yeah, there's a book he suggests us to read. This is a random walk down Wall Street. Yeah, I think it's a very good book. Yeah, because it tell us that investing in stock is like a random walk in the Wall Street. Yeah, because it's so unpredictable. Therefore, we need to really understand of the overall picture of the company and the investment that we will do. Look at this book, Pak.
Oh, okay.
Okay, let's go on this together.
Gordon Malkiel, the author of this book, he might not be as famous as Warren Buffett. Burton Gordon Malkiel is an academic. He has been a popular teacher of generation in Princeton student and is responsible for a revolution in the field of investment management. Burton Gordon Burton Gordon Malkiel, ya, ulang ya.
Potong lagi aja langsung aja, nanti kan dipotong.
Gak apa Bu, dipotong nanti.
Ya udah,
Langsung lanjut aja.
aku ngomong lagi ya.
Ya.
Burton Gordon Malkiel, the chemical bank chairman, professor of economics. Burt was born in Boston, Massachusetts, and he attended the Boston Public Latin School, Harvard College, and Harvard Graduate School of Business. He joined the investment firm of Smith, Barney & Co. as an investment banker. He received his PhD from Princeton in 1964 and joined the faculty that year. During his career, Burt has served on government advisory committee and on several corporate boards of directors. Based on the book A Random Walk Down Wall Street by Burton Malkiel, investing is often considered to be a difficult job, and financial success only can be achieved by highly knowledgeable Wall Street traders. A Random Walk Down Wall Street explores how the individual investor can make money in the stock market by following simple path that the investor has passion and get accustomed to a series of concepts about stock and what analyzing them consists of. So random walk basically is unpredictable. Short-run changes in stock prices are unpredictable. Investment advisory service, earning forecasts, and complicated chart pattern are useless. Even Malkiel mentioned that a blindfolded monkey throwing dart could select a portfolio that would do just as well as one selected by the expert.
It is the definition of the time period for the investment return and the predictability of the returns that distinguish an investment from speculations. Investing versus speculating. Investing are purchasing assets to gain profit, reasonably predictable income, and or appreciation over the long term. And speculating are buy stocks and hoping for a short-time gain over the next days or weeks. Get rich slowly but surely. Inflation rate close to 4% in 1962 to 2014 period. Investments have to produce a rate of return equal to inflation. If inflation were to proceed at 2 till 3%, the effect on our purchasing power would be still devastating. Morning newspaper has risen 4,1900%. Hershey bar is 20 times more expensive and it's actually smaller. It is clear that if we are to cope with even a mild inflation, we must undertake investment strategies that maintain our real purchasing power. Otherwise, we are doomed to an ever-decreasing standard of living. Traditionally, the pros in the investments community have used one of two approaches to asset valuation: the firm foundation theory or the castle in the air theory. The understanding of these two approaches is essential if you are to make sensible investment decisions. Firm foundation is a stock, even a piece of real estate have a firm anchor of value known as intrinsic value. Fundamental analysts fall into this bucket. They are looking for current and future earnings and dividend yields, and they work back to determine the intrinsic value of the stock. Castle in the air theory. Basic value. Investors were more inclined in analyzing crowd behavior known by technical analysis as trend without any consideration of the stock value. Malkiel said, in this kind of world, a sucker is born every minute and exists to buy your investment at higher price than you paid for them. Any price will do as long as other may be willing to pay more in theory. The investor looks to buy high and sell higher versus the firm foundation to buy low and sell high. Growth and momentum stock are likely the selection of this bucket. Continuing Castle in the air theory, in this book, Malkiel also mentioned about madness of the crowd and herd mentality. Herd mentality is a strong form of pressure that happens when we feel peer pressured. This derives from our natural inclination to stick with groups of people and therefore change our opinions to match with the general group sentiment. In the money market, this can prove to be detrimental to our finance, as we sometimes feel like we should get into hot stocks and not lose the momentum. Therefore, never buy a stock just because someone else does so, as you're most likely going to end up in a bubble that's about to burst. Malkiel explains some bulbs craze happened in the past, such as tulip craze, biotech craze, stock market, .com, and real estate. This bubble eventually burst, many dropping piece 15 to 19%. Sellers who buy at high price will experience huge loss. An understanding of how vulnerable we are to our own psychology can help us avoid the stupid investor delusions that can screw up our financial security. Herd mentality particular is often the cause of asset bubbles. Getting rich quick, getting swept out into speculative investment indecision usually leads you tumbled by the herd. Malkiel suggests to make transitional from irrational to rational investor. We must avoid the herd mentality over trading IPOs and hot tips and sell losers, not winners.
Fundamental analysis. The market is 90% logical and only 10% psychological. Determined stock proper value is related to company's asset, its expected growth rate of earning and dividends, interest rates, and risk. Estimate a security's intrinsic value, firm foundation of value, above market price, advice to buy. Technical analysis is part of Castle in the air. Predicting the appropriate time to buy or sell stock. Making and interpreting of stock chart. Study the movement of common stock prices and the volume of trading for a clue to the direction of the future chain. Chartists believe that the market is only 10% logical and 90% psychological. He severely criticized technical analysis, saying that most correlations are doubtful and that when you focus on chart, you are focusing on the micro and losing sight of the micro. Indeed, when a completely random chart was shown to some famous chartists, they couldn't tell the difference between a random walk and a real stock's movement. Because on the random walk, by flipping a coin and record when it's head and tail, we can make a similar chart like that. Fundamental analysis better but still not perfect. The analyst may receive incorrect information, losing the bad information. The analyst's estimate of value may be faulty. The market may not correct its mistake, and the stock price may not coverage to its value estimate. Even with correct information and value estimate, the stock you buy might still go down. Using fundamental and technical analysis together. Rule 1. Buy only companies that are expected to have above average earning growth for 5 or more years. Rule 2. Never buy more for a stock than its firm foundation of value. Rule 3. Look for stock whose stories and anticipated growth are of the kind of which investors can build the castle in the air.
Malkiel conducting a long-run study to try to document the risk, and he provided some allocation principles. Provided a table showing a history of performance and a clear correlations between the risk and return relationship for a given asset. Here we can see the distribution of a return during the period 1926 to 2018. In terms of distribution of return, we can see a positive bias amongst the asset. So if we are not able to predict short-term asset, which is the foundation of random walk theory, Malkiel does acknowledge that over a long-term period, there is a predictability of achieving high return from being a higher risk. Malkiel elaborated a diversification method in practice. He pointed out 5 points. First, risky, volatile stock becomes less risky when combined as a whole. Second, diversification of assets that has negative covariance. Third, true diversification is holding a portfolio of uncorrelated stock which can reduce risk and volatility when constructed correctly. Fourth, the more stock you add, the more your result will resemble the return and the less random walk it would become. Fifth, the longer the time period for which you can hold on to your investments, the greater should be the share of common stocks in your portfolio. Invest in a fully diversified portfolio or index. Make periodic investment benefiting from dollar cost averaging and takes advantage of the immense power of compounding. $1 saving in the year 1801 would have compounded over 27 million on 2021. An investor would be better off buy and hold an index whilst benefiting on diversifications and eliminating the destructive psychological traits that often common investor trying to beat the market. Stock move in a random pattern which cannot be predicted. The shorter that time frame, the more random the movements will be. Technical analysis is mostly tricky, while fundamental analysis is biased on actual data but still poor at predicting the future. Anything less than a decade is pure randomness. The past is very inconsistent indicator of the future. Hit the market, and if even trying would require so much time and effort, what are the alternatives? Invest in index funds. Avoid actively managed funds. Don't overtrade. Start early.
I hope you learned a lot from this video.
So if you like this video, don't forget to like,
Comment
And subscribe.
see you next time!